An investment strategy called short squeezing seems to have turned financial markets upside down, but the squeezers could end up accidentally strangling themselves. Short squeezing is quite an old idea that's recently become popular on social media sites like Reddit. First, you find a company that's heavily shorted, like games retailer GameStop. This just means that a bunch of hedge funds have placed bets that its share price will go down. Now, a big enough gang of squeezers can actually put these hedge funds in trouble by forcing the price to go up instead. They just do this by buying some options contracts, which basically forces some market middlemen to buy the shares themselves. Now, the hedge funds who were shorting the company will be in trouble because the share price has gone up instead of down. They will try to limit their losses by buying the shares, but, you guessed it, this just pushes the price up even further, effectively tightening the squeeze. So all in all, it's basically a feedback loop in the market, where higher prices can feed on themselves, begetting even higher prices. So what's the problem? Well, one risk is that the squeezers won't be able to squeeze indefinitely. Trading platforms like Robinhood and interactive brokers have placed restrictions on GameStop, for example. Regulators like the Securities and Exchange Commission might also take a dim view of the volatility that squeezing creates. The other problem for squeezers is that hedge funds usually short companies for a reason. They're bad investments. So if the squeezers try their trick, but then they fail to push prices upwards, they'll just end up owning shares in a company that's actually maybe a bad company. That could happen, for example, if major institutional investors start selling in as prices rise, or if just not enough squeezers join in the game. In other words, the risk from trying to squeeze too often is self-asphyxiation.